I want to share a story about a Tuesday morning that changed everything for a man named Walter. Walter is 67 years old, retired for 3 years now. He spent his entire career as a high school principal, 31 years of overseeing budgets, managing payroll, ensuring every single dollar in his school district was properly accounted for. He understands finances. He is careful with money. He has always been careful with money. 3 years ago, when Walter retired, he did what many responsible people do. He took his retirement savings, money he had spent 3 decades building up, and placed it in his bank, his local community bank, the one he had used for 19 years, the place where the staff knew him by name. He kept everything in one account because it felt secure, because it was familiar, because no one ever suggested there was any reason to do otherwise. Last year, Walter received a letter not directly from the IRS, but from his bank informing him that they had submitted a federal report concerning his account, a report that had flagged his account for review by federal financial authorities. Not because he had done anything wrong, not because a single dollar of his money came from illegitimate sources, but because the way his funds were sitting in that account and the way he had been conducting transactions, completely ordinary activity from his perspective, had activated automatic federal reporting requirements that Walter had never once been told about. Walter reached out to me. He was not angry. He was experiencing something far worse than anger. He was frightened. He told me, "I worked 31 years for this money. I did everything the right way. How is it possible that doing everything right got me flagged?" I spent 40 minutes on that phone call walking Walter through 5 specific rules about bank accounts and federal reporting that the majority of seniors have never been informed about. Rules that are currently in existence, rules that are actively being enforced right now, rules that determine when your bank is legally required by federal law to file reports about your account without your knowledge, without your consent, and with no obligation to notify you before they do it. By the end of that conversation, Walter fully understood what had happened to him, and more importantly, he understood precisely what to do differently going forward to make sure it never happened again. In this video, I am going to share with you everything I walked Walter through, the 5 things every senior needs to understand about how much money to keep in a bank account, what triggers automatic federal reporting, and what steps you can take right now to protect yourself and your hard-earned savings. This is not about hiding money. This is not about avoiding taxes you legitimately owe. This is about understanding the rules of the financial system your money is living inside. Rules that the bank is not going to walk you through, and that the government is certainly not going to send you a helpful guide explaining. Stay with me. Before I get into the 5 rules, I want to be completely upfront about something, because this topic attracts considerable misinformation online, and I want to make sure everything I share with you is grounded in actual law. The rules I am about to explain are not rumors. They are not theories. They are documented federal statutes and regulations that have been in effect for decades. Some of them you may have encountered in pieces: the $10,000 rule, the structuring law, FDIC coverage limits. But partial information can be genuinely dangerous when the complete picture is what actually protects you. Here is the broader problem that affects seniors specifically. Most seniors accumulated their savings during an era when banking rules were more straightforward, when the relationship between a person and their financial institution was simpler, when keeping a significant sum of money in a single local bank account was the obvious, safe, and responsible approach. The regulatory landscape has shifted considerably since then. Federal reporting requirements have expanded. Digital monitoring has grown far more sophisticated. The thresholds that trigger automatic federal reports have not been adjusted to reflect inflation in decades, which means that amounts of money that would have been considered modest savings 40 years ago now sit comfortably above the reporting thresholds that existed when those thresholds were first established. And here is the specific situation that creates real challenges for seniors. Seniors are often conducting financial activity that is entirely normal for their stage of life. Taking distributions from retirement accounts, receiving Social Security benefits, managing proceeds from an inheritance, consolidating accounts after the passing of a spouse, making significant purchases like home repairs or medical equipment. These transactions are entirely legitimate. They have perfectly reasonable explanations. But several of them can, without proper awareness and thoughtful structure, trigger federal reporting requirements that create the appearance of a pattern that regulatory agencies are specifically trained to examine more carefully. Walter's experience was not unique. I encounter variations of it on a regular basis, and every single time the person at the center of it is someone who handled everything correctly financially, but was simply unaware of the reporting rules governing the system their money operated within. You are about to understand those rules. If you want financial and legal information that helps protect your savings before you ever need it, subscribe right now and turn on your notification bell. This channel exists precisely for this purpose. Now, the 5 rules. Rule number 1, the $10,000 cash transaction reporting requirement. Let me begin here because this is the rule most people have some awareness of, and also the one that is most frequently misunderstood in ways that lead to real problems. Under the Bank Secrecy Act, a federal law that has been in effect since 1970, any cash transaction of $10,000 or more must be reported by the bank to the federal government using what is called a currency transaction report, or CTR. This is automatic. It is mandatory. The bank has no discretion about whether to file it, and you do not need to be engaged in any wrongdoing for the report to be submitted. Here is the first thing most people do not understand about this rule. The $10,000 threshold applies specifically to cash, meaning physical currency, not to checks, wire transfers, or electronic payments. If you deposit a $10,000 check, the bank does not file a CTR. If you deposit $10,000 in physical cash, they are required to. That distinction matters enormously. Here is the second thing most people do not understand, and this is the element that affected Walter. The CTR is not itself a red flag. Banks file millions of them every year, and the overwhelming majority result in no follow-up action whatsoever. What transforms a CTR from a routine filing into something that draws closer scrutiny is when it appears alongside other patterns in the account, which leads me directly to rule number 2. A note on what you should do if you ever need to deposit or withdraw more than $10,000 in cash. Simply do it. Do not avoid it or restructure the transaction to stay under the threshold. The act of deliberately breaking up transactions to avoid the $10,000 reporting threshold is itself a federal offense, regardless of whether the money involved is entirely legitimate. I will go into more detail on this in rule number 2. Rule number 2, the structuring law that ensnares innocent people. This is the rule that most directly explains what happened to Walter, and it is the rule that has produced the most unjust outcomes for law-abiding individuals, including a meaningful number of seniors in recent years. The federal structuring law, codified at 31 U.S.C. section 5324, makes it a federal offense to divide financial transactions specifically for the purpose of avoiding the $10,000 CTR reporting requirement. On the surface, that sounds reasonable enough. Deliberately obscuring large cash transactions should be prohibited. Here is where the issue becomes serious. The law does not require the government to demonstrate that you were aware of the reporting requirement. It does not require the government to prove that your money came from any illegitimate source. It does not require the government to establish that you intended to evade taxes or commit any separate offense. Under the structuring law as it has been applied, and the Supreme Court has addressed this in ways that continue to generate significant debate, the government can pursue a structuring case based entirely on the pattern of transactions, regardless of the innocent explanation behind them. The relevant agencies operate pattern recognition systems specifically designed to identify what they call sub-threshold structuring, a series of deposits or withdrawals that each fall just below $10,000, occurring in a pattern suggesting deliberate avoidance of the reporting threshold. Seniors are especially vulnerable to this because of entirely innocent behaviors. A senior who receives a large insurance settlement and deposits it across several visits because making one very large deposit feels uncomfortable. A senior who makes periodic withdrawals from savings to pay home repair contractors in cash because those contractors prefer payment that way. A senior who consolidates savings from multiple accounts over several weeks in amounts below $10,000 because they are proceeding cautiously and deliberately. All of these patterns can prompt a structuring inquiry. Not because the money is from any improper source, not because there is any wrongful intent, but because the pattern matches a recognizable profile. A note on what you should do. Deposit and withdraw money in natural amounts that genuinely reflect your actual financial activity. Do not artificially adjust transaction sizes based on what you believe the bank may be monitoring. If you have a substantial sum to deposit, deposit it in one transaction. A CTR will be filed, and that is perfectly acceptable. What creates legal exposure is a pattern of transactions that appears deliberately designed to remain under the threshold. Rule number 3, the FDIC insurance limit you may already be exceeding. This rule is different from the first two. It is not about government reporting. It is about protecting your money from something most seniors have not thought carefully about since the financial crisis of 2008. FDIC insurance, provided by the Federal Deposit Insurance Corporation, protects bank deposits up to $250,000 per depositor per bank, per account ownership category. That means if your bank fails, the FDIC guarantees your deposits up to that limit. Here is the concern. Many seniors, particularly those who have consolidated assets after retirement, after the loss of a spouse, or after receiving an inheritance, carry balances that exceed $250,000 at a single institution. And most of them are completely unaware that the portion of their balance above $250,000 is entirely unprotected. If that bank were to fail, an event that seems remote until it actually occurs, and that has happened multiple times in recent years, the amount above the FDIC limit is not covered. It enters the general pool of the bank's remaining assets. You become an unsecured creditor, and recovery of those funds is not guaranteed. For seniors living on fixed incomes who cannot absorb the loss of a portion of their savings, this is not a hypothetical concern. It is a real and manageable one once you have the right information. A note on what you should do. Calculate the total amount you hold on deposit at each financial institution. If any single bank holds more than $250,000 in your name, consider moving the excess to a different institution or a different ownership category, such as a joint account held with a spouse which carries its own separate $250,000 limit in order to bring each insured category under the coverage ceiling. This is not a complicated process. It is not a tax strategy. It is simply understanding how the insurance protecting your money actually functions. Rule number 4, the 1099-INT reporting threshold and what it means for your savings interest income. This rule is the quietest one on this list. It generates no enforcement activity. It creates no legal exposure for people following the rules. But it costs seniors real money every year in the form of taxes they could have anticipated and planned around if only they had known this requirement existed. Every bank is required by the IRS to issue a Form 1099-INT to any account holder who earns $10 or more in interest during a calendar year. That form is submitted to both the account holder and the IRS. The interest income reported on it is taxable as ordinary income, taxed at your marginal rate, added to your Social Security income, your pension income, and any other income sources in your overall financial picture. For seniors who are carefully managing their total tax situation, particularly those for whom additional income can trigger increased Medicare premiums or push Social Security benefits into higher taxability thresholds, interest income from savings accounts is not a passive background detail. It is an active variable that warrants serious attention. Here is the specific concern in the current environment. Interest rates on savings accounts are meaningfully higher today than they were 3 to 5 years ago. A senior with $200,000 in a high-yield savings account earning 4% interest is generating $8,000 in interest income annually. $8,000 that is taxable. $8,000 that may push total income above a threshold that triggers higher Medicare premium calculations. $8,000 that many people did not account for when planning their income picture for the year. A note on what you should do. Know how much interest your accounts are generating each year. Calculate whether that interest income is affecting your tax bracket or your Medicare premium situation, and consider, with guidance from a qualified professional, whether tax-advantaged alternatives for a portion of your savings make sense given your specific circumstances. The 1099-INT will be issued whether or not you are prepared for it. Being prepared is entirely within your control. Rule number 5, the suspicious activity report you will never be told about. This is the rule that completes the full picture and the one that most directly explains how a bank can file a federal report concerning your account without ever informing you that it has done so. In addition to the mandatory CTR for cash transactions exceeding $10,000, banks have both the authority and, in many cases, the obligation to file what is called a Suspicious Activity Report, or SAR, with the Financial Crimes Enforcement Network whenever they identify activity they believe may involve potential money laundering, structuring, fraud, or other financial offenses. Here is what makes the SAR fundamentally different from the CTR. A CTR is filed automatically based on the dollar amount of the transaction. You know the threshold. The filing is a known and disclosed process. A SAR is filed based on the bank's internal assessment of the nature of the activity. There is no specific dollar threshold. There is no automatic trigger. It is determined through internal compliance staff review. And here is the element that most people never learn exists. Federal law prohibits the bank from informing you that a SAR has been filed regarding your account. They cannot tell you. They are legally barred from disclosing it. The report goes to the relevant federal agency, which shares it with law enforcement, and you have no awareness that any of this has taken place. What types of activity can prompt a SAR filing? Transaction patterns that are inconsistent with a customer's known financial profile. Sudden and significant increases in account balances without a clear apparent explanation. Frequent cash transactions. Transactions that appear to serve no evident financial purpose. Account activity that is substantially inconsistent with the customer's stated occupation or income level. For seniors who may be receiving inheritance proceeds, insurance settlements, proceeds from the sale of a home, or who are consolidating accounts following a major life event, these patterns can appear in their accounts through entirely innocent circumstances. A note on what you should do. Be prepared to explain any significant shifts in your financial activity in the event that a bank compliance officer reaches out to you. Maintain documentation of major financial events such as the sale of a home, receipt of an inheritance, or an insurance settlement so that if questions are ever raised, you have a clear and organized paper trail that explains the origin of funds. And if you ever receive a call or written communication from your bank asking you to clarify specific transactions, consult with a financial attorney before you respond. You have done nothing wrong, but having clear documentation to demonstrate that fact promptly and confidently is what genuinely protects you. Let me bring all 5 rules together one final time. The $10,000 cash reporting rule. Deposits and withdrawals of $10,000 or more in physical cash trigger automatic federal reports. This is routine. It is not a problem on its own. Do not avoid it. The structuring law. Breaking up transactions to stay under the reporting threshold is a federal offense, regardless of whether the funds involved are entirely legitimate. Conduct transactions in natural amounts that reflect your real financial activity. The FDIC insurance limit. $250,000 per depositor per bank per ownership category. If your deposits exceed that amount at a single institution, the excess is unprotected. Distribute accordingly. The 1099-INT reporting threshold. $10 or more in interest income is reported to both you and the IRS. In the current higher interest rate environment, this income is significant and fully taxable. Know your number before tax season arrives. And the suspicious activity report. Your bank can file a federal report concerning your account without notifying you based on activity patterns they identify internally. Maintain documentation of significant financial events and be prepared to explain them clearly if ever asked. 5 rules, every one of them grounded in real law. Every one of them currently affecting seniors across this country right now, and not one of them explained to you when you first opened your bank account. Walter reorganized his accounts within 30 days of our conversation. He distributed his savings across multiple institutions to stay within FDIC coverage limits. He established a straightforward documentation system for any large transactions. He spoke with his CPA about the interest income he had not originally anticipated, and he has had no further issues since taking those steps. He reached out to me 6 months later and said, "I wish someone had explained this to me 30 years ago." You are being informed right now. Please share this with every senior you know who has significant savings held in a bank account. Share it with your adult children. Share it with anyone who is helping manage finances on behalf of an elderly parent, because these rules apply whether or not you are aware of them. And your bank is not going to walk you through any of this at the teller window. What happens if you believe your bank has filed an inaccurate or unjustified report that is now interfering with your ability to conduct normal banking activity? Check out the next video where I break down exactly what your rights are when a bank flags your account and the specific steps available to you to protect yourself and your continued access to your own money. Subscribe for more valuable content and updates. Like and share this video with someone who needs to hear it today.